My name is Stefan Königer. I'm managing partner of Koeniger Partner, a tax firm located in Stuttgart, Germany. Our tax firm specializes in both domestic and international tax planning for family businesses, high net worth individuals, family offices and trusts. Since real estate investments by persons who are not domiciled in Germany have increased substantially within the last 10 years, we would like to draw your attention how to tax efficiently structure your real estate investment in Germany. Part 1 of our series, German Real Estate Investments, Tax Efficient Structures, deals with natural persons not domiciled in Germany investing in real estate and the respective tax consequences. So let's assume that natural person NP, who is not domiciled in Germany, intends to acquire an apartment building in Berlin. The purchase price of the apartment building shall amount to 4 million euros. Besides incidental acquisition costs, notary, land register fees, real estate transfer tax is due. In Berlin, the real estate transfer tax rate amounts to 6%. So the real estate transfer tax due is 240,000 euros because it's based on the acquisition price. Please note that the real estate transfer tax rate ranges from 3.5% in Bavaria up to 6.5% in North Rhine-Westphalia. In the normal course of business, the real estate transfer tax is to be borne by the acquirer. So let's have a look at the annual tax consequences that natural person NP faces in Germany. Let's assume for our purposes that the rental surplus of the apartment building is 100,000 euros per year. The rental surplus of 100,000 euros consists of the rents minus depreciation of the building minus interest charges or other maintenance costs that are somehow linked to the apartment building. The interest rate for natural persons who are not domiciled in Germany ranges from 14% up to 47.5%, including solidarity surcharge. In our case, NP faces a tax due of approximately 39,000 euros. If NP sells this apartment building within 10 years after its acquisition, this will also trigger income tax. The income is based on the difference between the sale price minus the tax base of the apartment building, including depreciation and sales costs if applicable. Remember, we were talking about an income tax rate of 47.5%, including solidarity surcharge. Please note that the sale of the apartment building after 10 years of its acquisition is tax exempt. So there is no income tax due. That means if NP is a long-term investor, he can benefit from that tax regime in Germany. Depending on the respective double tax treaty in NP's home country, the income tax that has to be paid in Germany is likely to be credited in his home country on a pro rata basis. Or it is included in his income for calculating its tax rate, the so-called progression provisio. Another important aspect of directly investing in German real estate is linked to the inheritance and gift tax. If NP intends to transfer this apartment building, for example, to his child, transfer tax will be due in Germany. Its tax base is the fair market value of the building minus tax allowance of 400,000 euros in the case of a child, multiplied by the respective tax rate. If natural person transfers the apartment building to his child, this will amount to a tax base of 3.6 million. That means 4 million tax value of the apartment building minus a personal allowance of 400,000 for his child. Please note that the tax rate in tax class 1, for example, for spouse or children, ranges from 7% up to 30%. Furthermore, please note that particularities may arise if there's a double tax treaty in place with NP's country of domicile. In a nutshell, In many cases, directly investing as a foreign person does not make sense. I told you about an income tax rate up to 47.5% and the transfer tax rates up to 30% that you may face when you transfer your real estate to the next generation. The only advantage, to my mind, is that you can sell the apartment building after 10 years tax exempt. Of course, we can do better. In our next video, we will provide you with the tax consequences by investing via a German corporation. If you would like to find out how to ideally invest in German real estate, minimizing income tax consequences, avoiding inheritance and gift tax, and minimizing real estate transfer tax, including possible implications of the double tax treaty of your home country, please see our contact details below. We are looking forward to hearing from you. Yours, Stefan.